everybody? This is Jake from Goat Trading coming at you with another video. In this video, we're going to be talking about in the money versus out of the money options. We're going to be talking about what they mean, why ITM and OTM are important, and how they could be a use to you while trading options. Now, really quick, as usual, remember, go subscribe to the YouTube page, go follow the Instagram and Facebook pages, and go join the Discord chat. The link is in the description below. All right, now let's get it started. Now, first things first, in the money and out of the money options, what they mean. Out of the money options are, okay, say you have a call and the strike price is higher than the price of the stock. That call is an out of the money call. Now, say the stock price is worth more or is over the strike price, that is an in the money call. So, same thing for a put. Say you got a put that is $100 strike price, and say the stock price is at $110. That would be an out of the money put. Now, say you got that $100 strike price and the price of the stock is $90. That would be an in the money put. Now, OTM and ITM are, yes, pretty basic and straightforward, but they're very important to know. You'll notice when looking at options, the farther and farther out of the money the option is, the cheaper it is. As you get closer and closer to being in the money, or once you're in the money, as you go farther past the strike price in the money, the more valuable those contracts are. You'll also see that options that are far away from being in the money will increase in value by a lot less than contracts that are close to the money or that are in the money. And there's actually a way to figure out how much you can make or lose on your option for every dollar the stock price goes up or down. You use the Greek called the delta. It's one of the 5 Greeks, and it literally tells you how much you will make for every dollar that's, so you got a call for every dollar the stock goes up, or how much you will lose for every dollar the stock goes down. And remember, everything's multiplied by 100. So this 0.4757 is really about $47.50. So now really quick, I want to go deeper into out of the money options. I already told you the farther out of the money the option is, the cheaper it's going to be. You also have to remember out of the money options you cannot exercise them. You cannot exercise your calls or puts if the option is out of the money. Another thing to remember with out of the money options is how to use them. You don't want to use a far out of the money option when you only have a week till expiration, but you also don't want to use up all the money in your portfolio on very close to the money or in the money option that has a year until expiration. When it comes to short-term trading, you want to buy as close to in the money options or in the money options because of time decay. When you're buying contracts only have a week, 2 weeks, or 3 weeks until expiration, even a month, the time decay is gonna build fast. It'll build faster than you realize. And when it gets down to those last couple days last week, and that option you're trying to get a profit on it, if that option isn't booming or shooting up, or if it's a put, if it's not going tanking down, that theta, which is the Greek for time decay, we'll talk about that later, is just going to be eating away a lot of the value of your option, and you're going to be losing money because of that. That's why you want to get in the money options or close to in the money so that you're making a lot of profit as the stock goes up. You're gaining a lot of money. That way, it's really beating out the theta by a lot. When it comes to long-term investing, you don't have to worry about as much about buying in the money or close to in the money options because time decay is not a factor when you have 9 months, a year, 6 months until expiration. So you could buy a farther out of the money option, save yourself money in your portfolio to use for other investments, and you have a lot of time for that stock you bought the option for to grow, to swing, to do whatever you need it to do. That way, when half the days are done and you're halfway till expiration, you could reevaluate, see if you wanna hold that option, you could sell it, you could buy another one, you have time to work with, you're not pressured from the time decay, you have options with long-term investing, you're not always up against the clock with long-term options trading. And now we'll get into in the money options. Just as out of the money options, you cannot exercise your calls and puts. Within the money options, you can because they're in the money. But you need to remember the break even point. You will still not make a profit if you go to exercise your options and they're just barely in the money. One thing you need to look out for and make sure is that you will be profiting when you or if you exercise your options while they're in the money or when they're in the money. Another thing about in the money options is they make you more money for every dollar movement up or down the stock makes. So, for instance, if you had an option that had a strike price that was in the money by $10, that option's gonna make you a lot more money for every dollar movement up or down, depending on what you need it to do, compared to an option that's $10 out of the money. But here's the thing about in the money options, they are always more expensive than out of the money options. So, with short term investing, that's when you're going to want to buy in the money contracts or close to being in the money contracts because they're going to get you those gains you're looking for even up against that time decay. Whereas far out of the money options or even, a little bit out of the money options are going to have not as good of a chance of getting you profit as it gets closer and closer to expiration. Long-term investing, on the other hand, is different because say you take an in the money option and you get and it's one with 6 months, 9 months, a year till expiration. Well, that contract's already in the money, and you're giving it that much time until expiration to get farther and farther and farther into the money. So that contract, those in the money options are gonna be expensive contracts. They're not gonna be cheap because 'cause they're in the money and they have tons of room and time to grow and get more and more into the money, so they're gonna be expensive. So, long-term investing wise, that's when you should feel more comfortable in buying out of the money, whether it's a little bit out of the money or, even a little farther out of the money, you should feel more comfortable buying those out of the money contracts and not feel like you have to buy in the money contracts to feel safe with your investment. And with that being said, that's it for this video. Thank you all so much for watching, and I hope y'all have a lot better understanding of what in the money and out of the money options are, why they are important, and how you could use them while trading options. I hope you guys also have a little bit better of an understanding of how risky out of the money options could be. Thank you again, and I can't wait to see y'all in the next video.